128 million ounces. That's how much registered silver sits in COMEX vaults right now, available for delivery, ready to settle futures contracts. Sounds like a lot, right? Here's the problem. In December 2025, something happened that should terrify anyone paying attention. Over 60% of that registered inventory, approximately 47.6 million ounces, got claimed for delivery in just 4 trading days. 4 days, not 4 months, 4 trading sessions. And here's what nobody's talking about. The demand didn't stop. Open interest for January 2026 delivery is at record highs for minor delivery months, meaning more contracts are demanding physical delivery right now than at any comparable period in history. So let me ask you a simple question. What happens when the next wave hits? What happens when another 5 million ounces get claimed in 24 hours? Because based on current delivery patterns, that's not a question of if, it's a question of when. Let me show you exactly what's happening inside COMEX vaults right now, why the entire paper silver market is on the verge of a structural break, and why this window, this moment we're in right now, won't last. Before we get into the mechanics of what's breaking, you need to understand how COMEX silver actually works. Because most people think COMEX is just a price discovery mechanism, a place where buyers and sellers agree on what silver is worth. That's not what COMEX is. COMEX is a promises factory. Every futures contract represents 5,000 ounces of silver. When someone buys a contract, they're not buying silver. They're buying a promise that they can get silver if they demand delivery. And for decades, this system worked because almost nobody demanded delivery. Maybe 2% of contracts. The rest got rolled forward, closed out, or cash settled. The paper market functioned smoothly because physical demand stayed low. Now, here's where it gets interesting. COMEX silver is divided into 2 categories, registered and eligible. Registered silver is available for delivery against futures contracts. It's sitting there with warrants issued, ready to go. Eligible silver meets COMEX quality standards, but doesn't have warrants issued. It's stored in COMEX vaults, but not available for immediate delivery. As of early January 2026, COMEX reports approximately 128 million ounces in registered inventory. Total inventory, including eligible, sits around 300 million ounces. That ratio matters, because when physical demand surges, eligible silver doesn't automatically convert to registered. It requires owner consent, and right now, owners aren't converting, they're withdrawing. Since September 2025, registered silver has been draining consistently, not gradually, aggressively. According to market data, over 53 million ounces moved out of registered status between October and December. Some converted to eligible, much of it left the vaults entirely. And here's the part that should make you nervous. December 2025 saw something unprecedented. More than 60% of registered inventory claimed in 4 days. 47.6 million ounces. Gone. Demanded for physical delivery by contract holders who didn't want cash settlement. They wanted metal. COMEX responded by converting eligible to registered to meet demand. But here's the problem. That's not new silver entering the system. That's existing silver being reclassified. No additional supply. Just moving boxes on a spreadsheet. And when that happens, when COMEX has to cannibalize eligible inventory just to meet registered demand, you're watching a system under stress. Real stress. Not theoretical. Not maybe someday. Right now. Now, let's talk about what triggered this, because markets don't break for no reason. They break when multiple pressures converge at the same moment. Pressure 1 is industrial demand. Silver isn't just a monetary metal anymore, it's a critical industrial commodity. Solar panels, electric vehicles, AI data centers, 5G infrastructure, semiconductors, all of them require silver, and all of them are growing exponentially. According to the Silver Institute's December 2025 report, industrial silver demand hit a record 680 million ounces in 2024. Solar alone consumed over 200 million ounces. That's 29% of total industrial demand, up from 11% just a decade ago. And solar deployment isn't slowing down. The European Union targets 700 gigawatts of capacity by 2030. That means more silver, not less. Electric vehicles add another layer. Each EV uses 25 to 50 grams of silver, roughly double what a traditional combustion engine vehicle uses. Global EV production is projected to hit 15 million units in 2026. And by 2027, EVs will overtake combustion vehicles as the primary source of automotive silver demand. That's not forecast, that's trajectory. Add AI data centers. 80% of data centers are in the United States. Their electricity demand is expected to grow 22% over the next decade. AI alone adds another 31% on top of that. And guess what these data centers are choosing to power their operations? Solar, 5 times more often than nuclear. This is demand that doesn't respond to price. Manufacturers can't substitute silver in most applications. Copper and aluminum don't work. Performance drops, efficiency falls. Silver's electrical conductivity is unmatched. So when factories need silver, they pay whatever it costs. Period. Pressure 2 is the supply deficit. For 5 consecutive years, global silver demand has exceeded supply. In 2024, the deficit hit 282 million ounces, according to the Silver Institute. Total demand, approximately 1.3 billion ounces. Total supply, just over 1 billion ounces. That's not a rounding error. That's a structural gap. And here's why it matters. When demand exceeds supply every year for 5 years running, where does the additional silver come from? Stockpiles, above ground inventory, the reserves sitting in vaults and warehouses around the world. And those reserves are being drained. London Metal Exchange inventories fell to near all-time lows of 827 million ounces in December 2024. COMEX registered silver is down 70% from 2020 peaks. Shanghai inventories hit decade lows. The visible supply, the silver everyone can see and track, is disappearing. And here's the uncomfortable truth. About 75% of silver is mined as a byproduct of copper, zinc, lead, and gold extraction. That means silver supply doesn't respond directly to silver prices. Even if silver doubles, miners don't increase silver output unless base metal economics justify expanding operations. And base metal prices right now? Weak. New mining projects take 8 to 12 years to develop. Permitting, financing, construction. Even if every proposed silver project got approved tomorrow, new supply wouldn't hit the market until the 2030s. The supply side is locked, cannot respond. Production is structurally inelastic. Pressure 3, and this is the big one, China export restrictions. Starting January 1st, 2026, 3 days ago, China implemented new export controls on refined silver. Only state-approved companies with annual production capacity of at least 80 tons and $30 million in credit lines can export silver. And they need government licenses for every shipment. Why does this matter? Because China controls 60% to 70% of the world's refined silver supply. Not mining, refining. The process that turns raw silver into the purity levels required for industrial use. When China restricts exports of refined silver, the entire global supply chain chokes. This isn't speculation. This is documented policy that went into effect 3 days ago, and the impact is already visible. Reports from industrial buyers indicate delivery delays extending from weeks to months. Premiums for physical silver are spiking, and futures markets are showing massive backwardation, where spot prices trade higher than future prices. That's not normal. That's a shortage signal. Now, let's connect these dots. Record industrial demand that can't be substituted. 5-year structural supply deficit draining global inventories. China export restrictions, cutting refined supply by potentially half. And all of this pressure is landing on COMEX. Because when industrial buyers can't source silver through normal channels, they turn to futures markets and demand delivery. Which brings us back to December 2025. 47.6 million ounces claimed in 4 days. That wasn't retail investors buying coins. That was industrial users and large institutions demanding physical metal because they couldn't get it anywhere else. And here's what terrifies the smart money. January 2026. Open interest is at record highs for miner delivery months, meaning the December drain wasn't an anomaly. It was the beginning. More contracts are positioned for delivery right now than historical patterns suggest should be possible. Think about the math. 128 million ounces registered. If another 60% gets claimed like in December, that's 77 million ounces. Registered inventory drops to 51 million. And at that point, the system is one bad day away from breaking entirely. But wait, you might say, can't COMEX just convert more eligible to registered? Sure, if the owners agree. But here's the problem. A significant portion of eligible silverbacks, ETFs, like SLV, that silver is spoken for, is not freely available. According to London Bullion Market Association data, 551 million ounces of London inventory backs ETF holdings. That leaves roughly 276 million ounces as float. Silver that could theoretically be mobilized under the right conditions. But when conditions tighten, owners don't sell. They hold. Because they know scarcity creates value. COMEX faces a liquidity trap. Demand is surging. Supply is constrained. And the mechanism designed to balance the two, conversion of eligible to registered, is breaking down because owners prefer to withdraw rather than convert. Now let me show you what happens when paper markets break. Because we've seen this before, not in silver, but in other commodities where futures markets faced delivery stress. March 2022, London Metal Exchange, nickel. Prices surged from $25,000 per metric ton to over $100,000 an hour. Short squeeze driven by supply concerns and concentrated positioning. What did the LME do? They suspended trading, canceled trades, forced cash settlements. They changed the rules mid-game to prevent a complete market collapse. This is the precedent. When exchanges face delivery stress that threatens the entire system, they intervene. They don't let the market break. They break the contracts instead. Now apply that to silver. COMEX has authority to force cash settlements when physical delivery becomes impractical. They can change margin requirements. They can impose position limits. They can suspend trading. They have done it before. In 1980, during the Hunt Brothers silver squeeze, COMEX changed rules mid-crisis. They banned new long positions. Forced liquidation only, silver crashed. The risk isn't that COMEX runs out of silver tomorrow. The risk is that COMEX changes the rules to prevent running out. And when that happens, when they force cash settlement instead of physical delivery, the paper market decouples from physical reality, prices diverge, trust evaporates, and anyone holding paper contracts learns an expensive lesson about counterparty risk. And here's where it gets interesting. Because some institutions have figured this out already. Reports indicate JP Morgan holds approximately 169 million ounces in COMEX vaults. That's potentially 40% of total COMEX inventories, registered and eligible combined. Industry analysts estimate JP Morgan has accumulated 675 million ounces since 2011, following their 2010 settlement over manipulation allegations. Why would the largest bank in America hoard physical silver while the paper market shows abundant supply? Because they understand the gap. They see registered inventories falling. They see demand accelerating. And they're positioning for the moment when paper promises can't be honored. This isn't conspiracy. This is public COMEX data, combined with analyst estimates following JP Morgan's acquisition of Bear Stearns in 2008. Large institutions with access to proprietary data make billion-dollar positions based on structural vulnerabilities. And right now, those vulnerabilities are in silver. So here's where we are. 128 million ounces registered, a record demand for January delivery. China export restrictions, tightening global supply, industrial demand hitting all-time highs, supply deficits extending into their 6th consecutive year, and a paper market that functions only as long as most participants don't demand physical delivery. One more wave like December and registered inventory drops below 80 million ounces, then 50 million. And at that point, the ratio between open interest and available silver reaches levels where COMEX either delivers or changes the rules. Now, I'm not telling you silver hits $100 next week. I'm not telling you COMEX breaks tomorrow. But I am showing you the mechanics of a system under extreme stress. And history teaches us that when stress reaches critical levels, resolution comes fast, not gradually, suddenly. This window where physical silver is still available, where premiums haven't spiked to 40% or 50% over spot like they did during COVID, where dealers still have inventory, this window is closing, not in years, in weeks or months. Because once registered inventory falls below critical thresholds, once industrial buyers realize paper contracts might not deliver, the scramble begins. And when that happens, price becomes irrelevant. Securing supply becomes the only objective. So the question is not whether you believe silver goes to $100 or $150. The question is whether you understand that a system built on paper promises is being tested by physical demand. And when those two forces collide, the paper doesn't win. This is pattern recognition, not prediction. Every commodity market that faces delivery stress follows the same sequence. Gradual drain, sudden spike, rule changes, decoupling of paper and physical. We're watching it unfold in silver right now, in real time, 128 million ounces. That's what stands between normal market function and structural break, and every day, that number gets smaller.